The signal is already on the tape, and anyone pretending it's just another commodity spike is either not watching closely or they're hoping you don't. Because gold and silver aren't merely moving up or down right now. They're reacting like markets react when the system itself is under strain, when liquidity gets selective, when confidence becomes a tradable instrument, and when the real story is hiding inside the plumbing. And here's the part most people missed. The pressure isn't just in the price, it's in the friction around the price. Margins, volatility, delivery incentives, and who's being forced to do what. Stick with me, because by the end you'll have a clean next week checklist. The levels that matter, the two scenarios that can hit you from opposite directions, and the one breakpoint that changes the math if it fails. Gold just printed a fresh all-time high around the mid-4600s and then pulled back on profit taking, and silver pushed through the $90 handle before snapping lower with typical silver violence. It's not a normal risk-on, risk-off doodle. That's a stress signature. Surge, gap, whipsaw. Then everyone rushes to explain it with whatever headline is trending that hour. And that's exactly how people get played, because the market uses the headline as a mask while it repositions underneath. Now, yes, there are loud macro reasons floating around. Geopolitical tensions, policy uncertainty, the constant hum of rate expectations. But if you stop there, you miss the mechanics. And the mechanics are where the truth leaks out. Here's the conflict. The mainstream narrative wants to frame gold and silver as emotional safe havens. Panic buying, fear trade. People are nervous. Clean story, simple story. Also incomplete. Because this move isn't just emotion, it's math. It's collateral, it's hedging, it's inventory reality, it's spreads and incentives, it's people getting forced out of positions they thought were controlled. And the market is telling you that with the way it's behaving, not just with the level it reached. And that's where the real pressure starts. Let's get anchored in what right now actually looks like so we're not doing vibes-based analysis. That's the underappreciated detail that reframes the story. Because if leverage gets more expensive and the market still pushes upward, it means the buying pressure is less optional than people think. It can mean forced covering. It can mean physical pull that doesn't care about your margin. It can mean institutions that are not price sensitive in the way retail is. It can mean the market is trading like it's front-running stress rather than celebrating growth. But that's not the part that matters most. What matters most is what that friction forces participants to do. When margins rise, weak hands don't choose to sell. They get forced. Some liquidate because they can't post more collateral. Some reduce risk because their risk manager is staring at a volatility chart like it's a fire alarm. Shorts have to make a decision. Keep paying the carry and margin and pray, or cover and stop the bleeding. And that forced behavior is where silver becomes a truth serum. Because silver is smaller, more volatile, and more sensitive to positioning, gold can glide, silver detonates. If you want a stress signal, you don't watch the calm instrument. You watch the one that breaks first. And that's why the metals crowd keeps saying gold and silver react before everything else. They're not claiming magic. They're saying the plumbing feels it first. Here's why. Equities can levitate on buybacks, index flows, and narrative. Credit can look stable until spreads suddenly aren't. Data can lag by months, but metals reprice trust in real time. Trust in currencies, trust in policy, trust in liquidity, trust that paper promises will remain cheap to roll. And when that trust gets questioned, you see it in collateral behavior and term structure before you see it in GDP prints. Because if this one level breaks, the math changes. Now let's talk calendar, because why now is never just because fear. Where some markets move hardest when positioning is crowded and the calendar forces decisions. January is one of those months where you get thin liquidity pockets, fresh allocation decisions, and a brutal reality check after everyone's year-end window dressing fades. But the real calendar trigger sitting in front of you is the combination of month-end pressure and derivatives timing. Options don't expire in a vacuum. They expire into positioning. And when you're heading into late January, you're dealing with a landscape where gold options and related hedges have to be rolled, closed, or exercised around specific last trade dates. That matters because options aren't just bets. They're hedging machines. Dealers hedge gamma. Funds structure exposure around strikes. And when the underlying price rips through major levels, like gold accelerating into new highs, like silver breaking $90, dealer hedging flows can amplify the move. Sometimes it's subtle. Sometimes it's savage. You get a push, hedgers have to buy to remain neutral. That buying pushes price higher, which forces more hedging, which pushes price higher. Reflexivity, the market chasing its own shadow. And then, right when everyone thinks it's unstoppable, you get the snap, because the same mechanics that accelerate can also reverse when the flow flips. That's why I'm not selling you a fairy tale. I'm giving you a map, 2 scenarios, 2 behaviors, and you're going to know what you're watching. But first, the mechanism that the mainstream never wants to explain, the paper market versus physical gravity. Gold and silver price discovery is dominated by paper, futures, options, unallocated accounts, leveraged expressions. That's not a conspiracy. That's market structure. It means a huge amount of metal exposure is really balance sheet exposure. The physical market matters, but it often expresses itself indirectly through spreads, through delivery incentives, through inventories, through the cost of borrowing metal, through premiums in key hubs, and through how easily arbitrage can keep paper and physical aligned. In calm times, the alignment looks clean. In stress, the alignment starts to slip. That's where you get the phrase paper versus physical tension. Not because some villain is twirling a mustache, because incentives shift. Because when trust is high, people accept paper claims. When trust drops, they want metal or they want collateral they can't print. And when that demand becomes immediate, time itself gets repriced. That's term structure. Contango and backwardation aren't just textbook words. They're the market's way of pricing urgency. In a healthy, well-supplied market, you typically pay a little more for future delivery because storage and financing exist and time has a cost. In a stressed market, the nearby contract can get bid because the market is paying for immediacy, because the metal now is more valuable than the metal later, or because someone needs exposure now for hedging, delivery, or balance sheet reasons. When the curve starts talking back, it's telling you whether the system is relaxed or tense, and that's where the signal lives. Here's another detail most people don't understand. Inventory is not one number. In the comics world, inventories are categorized in ways that matter. There's metal that exists in approved warehouses, and then there's metal that is actually registered for delivery against futures. People love to cite total stocks as if it's all equally available. It isn't. Some metal is eligible but not registered, meaning it meets specs, but it's not committed to delivery. It's someone's property sitting there, and they may have zero interest in making it deliverable at the price the market is offering. Under stress, deliverable supply matters more than there's metal somewhere. Because the futures contract is a delivery instrument at the end of the chain. If too many people decide they want the real thing, or if too many shorts have to deliver or close, then the availability of registered metal becomes a pressure point. And when that pressure point tightens, you can see it in spreads, in lease rates, in delivery volume, in the scramble for collateral. But that's not the only proof. We need a proof stack, not one argument, 5 or more. Because markets can fake you out, headlines can distract you. So here's the stack, and I'm going to translate every piece into so what for this week. Proof point 1, price behavior itself. Gold hitting a record and then pulling back modestly while still holding an elevated zone tells you buyers are present even after profit taking. In a blow-off top, you don't just dip a little, you crack hard. Proof point 2, silver's character. Silver breaking $90 is not normal volatility. It's the kind of move that tends to happen when positioning and leverage get stressed, when the market transitions from being driven by incremental buyers to being driven by forced participants. And forced participants don't care about your RSI. They care about survival. Proof point 3, the margin and collateral dynamic. A shift in margin methodology that scales collateral requirements with price is an explicit acknowledgement that volatility risk is high and the system is protecting itself. When the exchange changes the rules of friction and the market still pushes, that's a sign the underlying flow is powerful. Proof point 4, physical hub behavior. In places like India and China, local premiums can flip from discounts to premiums when retail and wholesale demand steps in after corrections. When local buyers start paying above global benchmarks again, it suggests real demand is responsive even at higher absolute prices. That doesn't mean to the moon. It means the physical side is not dead. Proof point 5, institutional and policy credibility stress. When markets are digesting headlines that even hint at political pressure on central bank independence, subpoenas, investigations, public attacks, that's not a soap opera. That's a risk premium problem. If investors believe policy could be politicized, inflation expectations can unanchor, term premia can rise, and trust assets get repriced. Gold loves that environment, not because it's mystical, but because it's neutral collateral. Proof point 6, macro repricing. When inflation data cools or surprises, it can shift rate cut expectations. Even if you don't care about the Fed, the dollar and real yields matter for metals. If the market leans toward easier policy, that reduces the headwind for gold and silver. And when that dovetails with geopolitical stress, you get a cocktail that pushes capital into hard assets. Proof point 7, product and market infrastructure responding. When a major derivatives venue announces new contract sizes, like a 100-ounce silver futures contract aimed at meeting retail demand, that's not a guarantee of anything, but it's a clue that participation is broadening and the ecosystem is adapting to demand. That's the stack. And it's why this move deserves respect, even if you're skeptical. But here's the twist. The same stack that supports the thesis also warns you that volatility will be weaponized. And if you don't prepare for that, you become exit liquidity for someone who did. This is where most retail investors get emotionally manipulated. They chase the straight line move. They feel smart for 12 minutes. Then the market whips them down 4% in a day, and they feel betrayed. They dump at the lows, then it rips again without them. That's not just bad luck. That's structure. Silver is built to do that because it's thinner, more leverage sensitive, and more reflexive. And gold is built to do it in a quieter way. Gap up, drift down, grind up, headline drop, recover. The market's job is not to reward your narrative. The market's job is to transfer money from the impatient to the prepared. So you need a psychology shield. Here it is. First, separate trend signal from noise. Trend signal is the ability of price to hold above key zones after shocks, the behavior of dips, and whether the market keeps buying into bad news. Noise is intraday chaos and headline chasing. Second, pre-commit to what would change your mind, not I'll see how I feel. A specific invalidation zone, a behavior shift, a structural tell. Third, assume whipsaws are part of the process. If you believe the stress thesis, you must also believe the market will try to shake you out before it resolves. That's not pessimism, that's pattern recognition. Because if this one level breaks, the math changes. Now let's explain the forced buying engine in plain English, short covering and margin pressure. If you are short silver futures and the market starts moving against you fast, your broker doesn't care about your macro thesis. They care about your margin. If margins rise at the same time price rises, it's a double squeeze. Losses increase and collateral requirements increase. That can force shorts to cover, meaning they buy back contracts they sold. That buying can become gasoline on the fire. Meanwhile, options dealers who sold calls might hedge by buying futures as price rises, especially if gamma exposure increases around big strikes, like $90 in silver, round numbers in gold, and major technical breakout zones. That is how a move goes from strong to violent. Not because everyone suddenly became a believer, because the system forced buying. And forced buying doesn't arrive politely, it arrives as a shove, but the market always demands payment. After forced buying comes either consolidation or a reversal spike if the flow exhausts. That's why you don't marry a one-direction story. You carry two scenarios like a professional. Here are the two scenarios for the next 1 to 2 weeks, and you can run them like a checklist instead of a prayer. Scenario 1, controlled pullback and retest. In this scenario, gold and silver cool off after the record highs. Volatility compresses a bit, and price tests support zones. Also, watch for physical behavior. Do premiums stay supportive, or do they vanish the moment price dips? If premiums stay, it suggests real demand is still there. Scenario 2, continuation squeeze and gap risk. In this scenario, the market doesn't give you a clean dip. It gives you a shallow dip and then rips again, especially into thin liquidity windows or around options roll timing. Gold could punch back toward the record zone quickly. Silver could reclaim $90 and then move in shockwaves. $2 up, $1 down, then $3 up. This is the scenario where people get hurt by gaps and forced moves. It's also the scenario where the headline narrative becomes completely useless because every hour will have a new reason. What confirms this scenario? Price holding above $90 in silver on a closing basis, gold holding above its post-record consolidation zones without deep retracement, and volatility staying elevated while the market refuses to break. The risk in this scenario is not missing upside. The risk is getting chopped to pieces if you don't respect position sizing and time horizon, because even if the thesis is correct, price can whip around violently. That's not a disclaimer. That's the nature of metals when stress is in the system. So what do you watch next week that's actually actionable? Start with the pressure points. Gold, the record zone around the mid-4600s is the obvious reference. The more important question is whether pullbacks remain shallow and whether the market keeps printing higher lows. If gold loses a key consolidation floor and cannot reclaim it within a couple sessions, the stress narrative weakens in the near term, not necessarily long term, but near term. Silver, the $90 level is the battlefield. Above it, the market is telling you forced flows and urgency may still be active. Below it, the market may be flushing leverage and resetting, but don't confuse a reset with a failure. Silver can drop hard and still be bullish if it recovers and retests from above later. The big invalidation tell would be a sharp breakdown that fails to reclaim, combined with calming in volatility and a collapse in physical premiums. That would suggest the urgency is fading. Now, the hidden metric you should keep in your peripheral vision, without turning this into an obsession, is trading friction and collateral stress. When margins change, when contract specs change, when the exchange adjusts risk controls, it tells you volatility is being priced as a system-level concern. That's not bearish or bullish by itself. It's a context signal. It means moves can extend further than you think and reverse harder than you think. The market is warning you. Manage risk like an adult. And that's where the real pressure starts. Let's talk about the economic stress signal claim directly, because skeptics deserve a clean mechanism. Why would gold and silver react before everything else? Because they are sensitive to the intersection of three things: real rates, currency trust, and liquidity conditions. When liquidity is plentiful and trust is stable, people prefer yield and growth exposure. When liquidity gets selective, when funding becomes more expensive, when political risk touches monetary credibility, when geopolitics starts to threaten supply chains and confidence, then assets that represent neutral value get repriced upward. Gold is the cleanest expression of that because it is not tied to one country as promised in the same way. Silver adds a second layer. It is also an industrial input. That means silver can move on macro stress and on procurement demand. And procurement demand is underrated. Industrial buyers don't wake up and say, I feel bullish. They wake up and say, I need to secure supply at a cost that doesn't blow up my margins. When supply chains feel uncertain, whether due to geopolitics, tariffs, shipping constraints, refinery throughput, or just higher volatility, procurement behavior can become less price sensitive. That can show up as physical demand holding up even after price spikes, which in turn can support the paper market because arbitrage links them. But arbitrage has limits. It requires metal, credit, and logistics. If the spread between regions widens and it becomes difficult to move metal fast enough, price can decouple temporarily. That's when the paper versus physical narrative gets loud, not because it's a cartoon, because it's the market describing a temporary friction in the chain. And if you want to stay grounded, you watch the chain, not the drama. Watch whether local premiums persist. Watch whether delivery incentives tighten. Watch whether the curve shifts toward urgency. Watch whether volatility term structure stays stressed. And watch whether price reacts to bad news the way a stressed market reacts. It shrugs, it dips briefly, then it snaps back. But here's a counterpoint you have to respect because credibility matters. Sometimes metals spike because of temporary fear and then mean revert hard when the fear cools. Sometimes you get a blow-off because retail pile-in meets thin liquidity, and then the market punishes late buyers. Sometimes central bank headlines and geopolitical shocks fade and capital rotates out. Sometimes higher prices themselves destroy marginal demand, especially for silver if industrial activity slows. That's real. That's why we use two scenarios and invalidation levels. If gold and silver cannot hold key zones after the calendar, catalysts pass. If options roll off, if the geopolitical tone calms, if the policy risk premium relaxes, and price starts making lower highs and lower lows, then the react first signal may be fading. Not forever, but for now. And you don't need to argue with the market, you just need to read it. Because if this one level breaks, the math changes. So what's the concrete payoff I promised at the start? Here it is. A next week checklist you can run in 5 minutes a day without getting hypnotized by headlines. 1, check whether silver can reclaim and hold $90 on a closing basis, or whether it keeps rejecting it. That's your volatility and positioning tell. 2, check whether gold holds above its post-record consolidation area. Does it get bought on dips, or does it sag and fail to recover? 3, watch for signs that trading friction is increasing again, margin updates, volatility spikes, sudden widening daily ranges. If friction increases and price still pushes, forced behavior is likely still in play. 4, keep an eye on physical cues. Do key hubs show premiums returning after dips, or do they go dead? Premium resilience suggests real demand is responsive. 5, pay attention to the calendar around late January. Options roll timing and month-end positioning can create sharp flows even if the macro picture doesn't change. 6, don't ignore cross-market confirmation. When metals spike alongside other commodities like copper and tin, it can indicate a broader repricing of real assets under geopolitical and policy uncertainty, not just a gold-only fear trade. And 7, define your invalidation. If silver loses a major support zone and fails to reclaim it while volatility collapses and physical signals fade, that's a near-term stand-down tell. If gold loses its consolidation floor and keeps bleeding without snapback, same. That's not you being bearish. That's you being honest. Now, let's talk about you, because the market is going to try to mess with your head. Here's how volatility will be used against you. First, you'll get a euphoric day where everything looks obvious. Then you'll get a vicious reversal that makes you feel stupid for believing the obvious. Then you'll get a rebound that makes you feel stupid for selling. That cycle is how people get emotionally liquidated. The shield is simple. Stop treating every tick as a verdict on your intelligence. Treat it as a test of structure. Ask, did the market break the level that would change behavior? Did it invalidate the scenario? Or is it just noise designed to trigger you? If you can answer that calmly, you're already ahead of most participants. And if you can't answer that calmly, your position is too big for your nervous system. That's the real risk management truth nobody wants to say out loud. Metals don't just test your thesis. They test your sizing. They test your patience. They test whether you can think in scenarios instead of certainties. And if you can, you become hard to shake out. That's where the edge lives. A quick word on what not to do. Donna T. Let a loud narrative drag you into fake precision. You don't need to pretend you know exact inventory numbers offhand or that you can predict the exact top. You need to know what forces participants to do. You need to know what confirms the stress signal. You need to know what weakens it. And you need to respect that both scenarios can happen in the same week. Rip, dump, rip. Especially when leverage and options are involved. That is why this is such a powerful economic stress tell, because when the system is calm, metals are boring. When the system is tense, metals are alive. And right now, they are very alive. If you want to stay on the right side of this, you don't have to be a perma-bull or a conspiracy addict. You just have to be a disciplined observer of incentives. Exchanges raise margins to control risk. Traders respond by reducing leverage or being forced out. Dealers hedge options exposure. Physical buyers respond to dips with premiums. Institutions allocate to neutral collateral when policy credibility becomes a question mark. That chain is the story, not the headline of the day. And the last piece, your subtle CTA because I'm not begging, I'm building a room. If you're the kind of person who wants the mechanism, not the mantra, you're in the right place. Stick around, track the checklist, and keep your ego out of the trade. Because the market doesn't reward conviction. It rewards correct conditioning. And if gold and silver are reacting before everything else again, the next confirmation won't be subtle.